kicking us off, and thank you all for being here. I am Randall Kempner, the Executive Director of ANDE, and I work for them. For the 50% of you who are ANDE members, I work for you. And for the 50% that aren't ANDE members, someday I could work for you. But under any circumstances, I'm thrilled to be here today and to be with this group and to dive into this issue. And I'm particularly excited to do it with Harold Rosen to my left, because he, I'm going to get in trouble for this, but that's all right. He's like the granddaddy of the industry. The team of GBF is laughing over there. I mean, if you think about one person who sort of helped create SME finance at IFC, you worked at microfinance there when it was just starting, all over the world at the International Finance Corporation, or Finance. What's the IFC stand for again, Harold?
You got it.
I got it right? So he's really seen SGBs before they were SGBs. And he has been both at IFC and then when he spun out the Grassroots Business Fund, a true fan and agent of change as it relates to metrics. It was the Grassroots Business Fund that, when ANDE first launched in 2009, decided that we should have this conference. And so we thought it would be appropriate 5 years in to bring back Harold and have a conversation about where GBF is, but also where he sees the field of metrics as it relates to asserting or assessing the impact of SGBs. So thank you, Harold, for being here and for your support of ANDE for even beyond it, but before it was founded, you were around trying to support it. So our gratitude for that. And let me just start, if I may, by asking you to give us an update in general of where things are at the Grassroots Business Fund, sort of what you're focusing on now, and then we'll dive into some questions about metrics.
Okay, can you all hear me okay? I guess the microphone's working. So thanks to Randall, and thanks to the whole ANDE staff. I know better than most how much work this is to put one of these conferences together, so it's really come a long way, and that means everything from the refreshments are good but not too good, to the content seems to be well stocked. So Randall's really done a great job with the team here of building up the whole organization as well as just the metrics part of this.
So you guys blew it. One year we had Dom Perignon, and Harold said we could not have that kind of champagne anymore.
That's right. We needed better champagne. No, but really, it's not just growing in terms of the obvious. It's a good example of metrics. It's not just growing on the gross indicators of lots of members, but it's doing things that give it a reason to exist and have it helping the field. So that's a good thing too, and good modeling of the behavior, I'd say, in metrics. So 5 years ago happens to be when we were about spinning out from the World Bank Group. And I had done something like this, or a predecessor stage, for about 4 years inside IFC before spinning it out. So I'd like to think I've been doing something like this SGB, base of the pyramid work, for maybe 9-10 years. And depending on how you count going back into my career in IFC, probably longer. So Randall sort of put his finger on it. There is a bit of a feeling of some of us that have been in the development business and even doing things like this a long time are, I don't want to say bemused, but it is interesting to see a lot of people getting interested in the field. Some of them viewing it as a new discovery. And I'm not saying there's anything wrong with a lot of new people coming in the field, but there is a pretty long track record. And I'd say metrics is one of the things that there's been the most research and work put in on. When I was doing this in IFC and I realized that metrics was going to be a very important part of showing why we should exist and what we're doing that's different, I did do a pretty serious piece of research as to what existed in the field of metrics. Myself, I had my staff do it, and I like to think I'm a tough guy. I've been in the development business a long time, and I should not have been surprised, but I was, at the discrepancy between the sophistication and volume of the thinking that had gone on in metrics. This is going back 6-7 years ago, versus what there was you could actually use for a portfolio full of difficult, small, funky investments. So we kind of, we looked at everything. We've joined all the groups. We were not just ANDE, but we were part of the founding group for IRIS and worked on GIN a lot. It was always very important to us, not just because we would have to justify ourselves to our funders, but also it was pretty clear that our investees could benefit from this. So in other words, using metrics as a way to strengthen the enterprises into which we invest. And again, GBF, just in terms of Randall's real question, which is track GBF, we have a bifurcated structure, you'd say, or a blended. We have two organizations. It's a for-profit fund of $49 million. That's investable capital. It's got to be returned with a principal and a return to the investors. So that's a regular partnership. And then we have a nonprofit of $11 million. That's grant money. And we can use that for capacity building, metrics, environmental and social work. The idea is that we're doing things with a sort of heavily subsidized structure for the capacity building. It's exactly what we did in the early stages of microfinance. It's still what's done in microfinance, although that's a well-kept secret, because a lot of people like to think microfinance is fully commercially viable. No one loves it more than me, but it's not. You know, the big subsidies go in to build every one of those organizations, especially the ones that make big profits. So as I always say when people run out of the room when I give them my spiel on a fundraise, wait a minute, that's just what we do. What we're doing in the SGB space is what everyone does in microfinance. A lot of people don't know that story, that there is such a thing as a smart subsidy, capacity building. So anyway, we have now finished our fundraise. We have, in theory, 5 years worth of money. We're 2 years into that, and we put $1 million or $2 million into each of, so far, 20 investments. Separately, we put a grant. We don't give the grant to the company, but we use it for things like metrics, environmental and social work, financial planning, governance, to strengthen the companies, which puts a very high bar because a lot of people do something like what we do without any grants and with at least promising better returns. I say promising and underline that because I'm not sure too many have gotten it. But we have a high bar in terms of showing are the projects we're doing better, harder, more developmentally worthy. And that's one of the many things we do with metrics. I would say the field has gotten much more crowded. That crowding is happening in a relatively small number of countries, and I'm not casting any aspersions on others because we're in the same countries too. We are starting to go into some places that are less traveled, and I would say one observation is we all should really think about going to where there aren't so many others. I mean, I can use India as an example because I bet you just about everybody in the room that does this work is in India. So are we. It's difficult. Deals get overbid very quickly, almost before they exist. Some of that's a regulatory issue of the Indian government. Some of it is just that everybody in the field is there, and it's an imbalance between supply and demand. But anyway, so we have I'd say 3.5 field offices. The half is Indonesia, which we're just starting, but we have serious 5-person offices in Lima, which covers the Andes, India, which covers all of India, and Kenya, which covers East Africa. These 20 investments we've done in our first year and a half are in basically spread across those 4 geographies. About 50 or 60% of them are in agricultural processing and marketing organizations. We didn't start out saying we wanted to be an agriculture fund, but given our criteria of we don't just do SGBs, we do SGBs that help lots of poor farmers or artisans or consumers. So the distributed business networks where there might only be a few hundred people working in the business, but there's usually thousands of farmers or artisans or consumers involved too. So those are the kind of businesses we do. We're 50% in sub-Saharan Africa. That wasn't our investors told us to do that. We just took that on as a commitment. And the rest is roughly a quarter each in India and the Andes. So we're doing a pretty serious job on metrics, and I don't know if this is part of what you wanted to sort of observe about GBF and where we are. Do you want to deal with that separately?
Well, no. I mean, I'll ask the question that I think you're about to answer. Like, look, you're all over the world, all over the emerging world. You're in all sorts of different sectors. You have both a technical assistance facility and you have direct investments. How in the world could you possibly measure it all?
You're not the first one who's asked that. First of all, the geographic spread is a big bet we're making. It's a pretty hideous geographic spread on one level for a $50 million fund. It's a calculated gamble that I just felt pretty strongly from all the work I had done that there wasn't enough deals in a narrow sector or geography to book a serious size fund. So we pay a price in terms of running a serious, 4 different field offices. But I think we're seeing it. We only invest in 1 out of 100 deals we look at. We have pretty good geographic risk diversification. So we do have a big spread. How can we measure it? I think we've scaled down probably 80% the sophistication of what we do on metrics. I'm still a huge believer in it, but part of what I believe is that it's so important that scaffolding at the expense of substance is often a problem. So I'm not saying a lot of metrics is scaffolding. Sometimes if you don't know how to do the practical end of it, you sort of do a complicated structure, and I think there's a lot of that going on in the space. So we still use IRIS and those indicators. We've been a big part of that. We basically went from an average of 8 or 10 indicators per project to probably 2 or 3. We're worrying about verifying the self-reported data, which just about everybody relies on, and finding some interesting things as we do that, which we can tell you more about. By the way, Allison and Rachel are here. That's our metrics teams, and they've done a great job on this. They're always having me bark at them to scale down things, which is strange because, on one level, there's this exciting things you can do, but there's also so many superstructures in this field and posting places and studies. It's really hard to find. So what do you do if I got to put $1.5 million in an agricultural project in Mozambique to see, are the farmers doing better? Is the company help? So we try to define, as we do due diligence, what are the 2 or 3 things we think we can answer with some simple metrics, and we try very hard to use IRIS indicators. We do count how many people are getting direct livelihoods out of what we do, but even that's a pretty funky indicator. What's a livelihood? How much did you have to do with it? But we count that. We also look at income injected into the base of the pyramid. That's often payments to farmers. It's sometimes to artisans, or it's savings for consumers. So one thing we've done is scaled that stuff way down and tried to verify what we do get. Another thing we're starting in India this year is a couple of pilots on metrics, where we're going to do a cross-sectional study of some of our big clients that have many thousands of beneficiaries. Because right now we know, and we've sort of verified the numbers of people they're reporting. But if you say, what castes are you addressing? This is I can say it's Jaipur Rugs. It's one of the large, it's in C.K. Prahlad's book. It's one of our clients. But it had a lot of issues, and we've worked with them for 1.5 years before we even put our money in, and we're helping them a lot with metrics.
Let me pause you for a second and ask you to go a little bit deeper. So it sounds like you've had a real change in strategy in how you've addressed metrics. Mm-hmm. So what was the aha moment or moments that made you say, gosh, we have to scale down instead of scale up? Because I think a lot of the discussions are much more about how we need to measure more, not measure less. So what brought you to this change?
I think it was once we started getting down the learning curve of actually having investments and seeing how fragile and challenged these projects are. It was really a lot of it just a plain old bandwidth constraints. A lot of these companies, and we're not working on the least developed in a lot of these countries, they're very challenged just making payroll, having something approaching a reasonable governance structure, basic financial plans. That's the stuff we do a lot of. So realizing that they're so challenged in bandwidth and they really can't afford all the management they need to do this, that we would have to make metrics A, simpler, and B, something they see value in. So a lot of it was, I always say, we're a grassroots business too, so anything we impose on our clients, let's do it to ourselves or see if it would help. And when you look at the metrics frameworks that way, we're struggling with the same thing. How do we report what we get done to our stakeholders who, before we get bigger or go on, they're going to want to see, so what did GBF get done? And it's not just the folding up of the different projects metrics. So we did that. This cross-sectional thing I'm excited about, because right now we can't really verify or show that we're helping a beneficiary group that is more worthy or different than what the 100 of other impact investors are doing in India. I'm pretty sure this has 23,000, I think, home-based workers. If you ask Jaipur Rugs right now, and not with us in the room, how much did this all help you? I think they would say that this really made a transformation. I don't want to say they may well have gone out of business, and I shouldn't speak of my clients this way in public. But I think in metrics is one thing where they had, for instance, when you got 23,000 home-based workers, you got a big a child labor issue. And you got lots of people in the world looking at that, hovering around, including talking to us, saying you better do something about that because that's a challenge. So making this a value add for the company. Jaipur Rugs was one of the ones that made me realize if we can't say that what we're doing on metrics is actually helping them not just protect themselves from global NGOs, but come up with a sensible policy. We verify these things as much as we work on the up front. People like to do the on-entry routine, but the monitoring as an investor. So we have OPIC and DEG and FMO. We have a lot of people who care a lot about doing business the right way. And if we were to say, okay, write a nice child labor policy, but we're going to forget about it as soon as you send it to us, we'd be in big trouble. Thanks.
But let me push you again, which is I've always believed that the metrics need to serve at least two purposes. One is to help the business do their job better, right? And the other, in this particular industry, is to help us, say the folks at ANDE and the Industry Association, make the case for why there's going to be some impact. And so I might be a bit afraid of you saying, well, you're reducing the number of metrics. Will that ultimately impact your own ability to raise capital, and will it impact the ability of others in the sector to raise capital if we're not actually showing enough impact because we're not measuring enough things?
It's a fair point. If we cut back too far and couldn't answer that second question, yes, it would be a problem. But if I can paraphrase what my board has said to me about this is, Harold, there's one predominant thing that's going to determine if you guys continue and grow, which is get a civilized return on your investment portfolio. And of course, be able to show that you're doing a decent job in development terms. But in other words, I hate to sound like I don't like field building, but they've said watch how much of your and your team's time goes into things that are non-essential for that purpose. Because no matter what we do on metrics and field building, if we don't have a decent investment return when we run out of money, which is less far off than I would have liked, we're finished as an organization. So it's a little bit being able to continue to help the field by at least making sure we survive. So it doesn't mean reducing it to nothingness, but it does mean making sure that it's practical. We do a lot of calculations. I think I'm overstating how much we've scaled this down. Things like social return on investment, looking at the base of the pyramid payments. We do a lot of that, and I think we have, as far as I can tell, as good or better than most players in the field. We would love to find structures like this through which we can participate and efficiently share our experience. What we really can't do is put a lot of our management time into metrics, conference. I like this conference, but
it's like he founded it, he comes back 5 years later,
What I would say is field building has, let's say, a practical and application side, and it also has, let's say, a theoretical and academic side. And
I agree, and I think the point that you make, that the best thing you can do for the field is be successful, is true. And I make this point not just to GBF, but to funds and capacity development organizations throughout the ANDE network. That's what we need. We need success stories. But we need to be able to prove that they're a success story. And so part of what I'm hearing you say is that, particularly given your focus, are you saying there are really no impact first investors out there? That everyone's a finance first investor? And that you could do this, you can be successful if you just return?
There's plenty of impact first investors. Just the way we structure ourselves, we have in our fund, we have, I'd say, return first, but impact is still important investors. So most of them, have plenty of funds they could invest in, and we have 30 angel investors that do and could invest more in private funds, but they think we're doing something hard and developmentally worthy. So yes, they absolutely want to see, things like, so how tough a mix of countries are you working in, and how much are you having to do with producing social benefits in your projects, and what are the social benefits? So we have a fair bit of that. We can show the multipliers on the money we put into projects in terms of base of the pyramid incomes. This sustainability, and why we're doing this cross-sectional study in India is it would be good, especially if we can do statistical sampling over time, to be able to show that more of the kids in the villages where diaper rugs works are going to school, for instance. That's something we can't do right now. But in other words, getting statistical sampling into the beneficiary level judgments here, I don't see a lot of models for that. So because our partners all have these distributed business networks, it doesn't have to be that cumbersome and expensive to do this. But coming up with models like that to say, yes, for 2% of assets in a year or something, we can do a decent job of tracking social impacts, for instance. I think that would be a contribution.
Just want to alert you guys, in a few minutes I'm going to let the audience answer some questions, but I still have a lot more for now, but generate. But, is there a target cost per overall impact assessment effort per company that you target? You just said 2% of assets. When you look at an investment, or do you say, well, this is the right number, it should be X% of our investment or X% of their revenues?
It's pretty hard to use numbers like that given how special each of these cases is, and it would be very hard. If we took an overall number, it would probably be, somewhere between 2.5% and 5%, I think, is what we are probably...
Of what?
Of the total assets invested. So in other words, thinking of it as an annual amount for a 2+20 or any kind of normal LP-GP structure, it's pretty out of the question, I'd say, to do what most of people in this room would think of as a fully professional job of metrics, for instance. So I think the challenge is, I mean, we're not 2 + 20 either, but we're at least a lot closer to that than what I would say pure grant funded or people that can spend any amount on this. I think part of the job is to come up with that, that frontier of how much it's costing versus how much benefit, and stop at the right place. Because it would be easy for us to go to 5 or 10%, and we'd have nicer and glossier reports to put on the table out there. But I don't think we'd be helping our businesses much. And our investors have made very clear to us what they would like to see in terms of social impact. And even our donors who give us the grant money, I think they, not coincidentally, we've ended up with, let's say, I would say a pretty practical group that also would like us to just come up with tools, practical experience. This may be one of the questions for later, but one of the things I noticed in microfinance that actually worked well is the practitioners were actually part of developing the ecosystem there. Things like CGAP and Mix and all those bits of ecosystem that were built were done very much with the early practitioners at the table. I haven't seen much of that in the development business. So I think one thing you're doing here is you do have practitioners. If you can get enough people who are actually struggling with the kind of challenges I'm talking about at the table, who are contributing to the frameworks, that would be big. That's why I've said we're going to talk about gin and gears, I think, in a minute. Gears has a very big role to play. It's important that people who are wallowing in the booking of assets and making these companies successful be part of that, because when you do that, unless I'm missing something, it's pretty hard to go through a complicated up-close metrics function if you have to worry about LP/GP structure and returns to your investors. So I think we're trying to find that balance, and having been known as interested in metrics and a big player in this earlier, including in my earlier career, I feel a little bit like I was given a bit of license with this. As I always say, it took Nixon to make friends with China. I think I got away with this probably better than a lot of people could have, just because I was seen as, okay, he's not going to be totally irresponsible about this. But it means that in another year or two, when we have to start talking about another round, that's when we'll find out if my bet was successful. Could be all the funders will say, well, we have so many other people that do a better job of this. Sorry, we're not funding GBF anymore. I don't think that's going to happen.
For Rachel and Allison's sake, let's hope not.
That's right. But if anyone has jobs, they might be looking. No, I'm just kidding. Sorry.
Let me ask you before we go back up to give us like a case study example of a company where it was particularly difficult. Maybe it's Jaipur Rugs, where you had to really help them develop their own metric system, their impact assessment processes. Because much of the discussion over the next 2 days, and we know in the sector, is it's how hard it is to actually get the data in a credible way. So give us a real case study of one company where you've had to really help them and you've been ideally satisfied with what's changed.
Now you're talking about real work. I may have to ask them for that. Actually, they've just been there. Maybe one of you guys want to give an example from your recent trip, like one of the cases where we've done a lot?
Go for it.
Sure. So I would say
Why don't you face the audience?
You guys hear me okay? I'd say our metrics work falls into 3 components. So one is this paring down that Harold's talking about is really what we ask the company to report on an ongoing basis. So rather than give them a list of 15 or 20 things to report to us for the purposes of our donors, we've narrowed that down to focus on the operational elements that they need to know for themselves. So things about their supplier base, how many artisans they're sourcing from, how much they're paying them in a quarter. So keeping it simple in that way. And we've supported Jaipur Rugs in this instance by helping them with their ERP, so their management information system. Another element is the social and environmental policies and practices. So helping them with things like, they've had a great child labor policy on their wall, but when it comes to making sure everyone, all of their employees throughout the supply chain are understanding that and integrating it and practicing it, we saw that some assistance was needed. So we're working with them on that, for example. And then the third piece is really, because we're finding that it's very difficult for a company that's, has to survive financially to really understand what's happening at the level of the supplier in terms of, moving above the poverty line, or how much they're earning, how that compares to what they were earning before. These very specific kind of survey level indicators. And just shifted how we try to get that information. Sorry. So now we are bringing in third parties to work with the company to develop these surveys. So we take the onus off of the company, but we still get the data because we're interested in it and the company's interested in it. It's just sort of a different approach that we're taking to get the data.
So one of the structural models we're coming up with, our ticket size on this technical assistance we do locally is really small. We can do that because we have these local offices, but sometimes it's $8,000 or $10,000 assignments. We had been doing this just on a spot basis, but when it comes to environmental and social metrics, we're actually bringing on what we call a portfolio person to do that. In other words, our staff, but we second them into the companies to help with that. We did that first with the CFO because all of the companies needed that. None of them could afford a real CFO. So we hired a real CFO and sort of float him around, make him come back to that works very well. So we're trying something like that in India now with one person for environmental and social and one for metrics. What that means is we'll subsidize, but the client also contributes. That person for 3 weeks there, he goes 2 weeks there. This kind of breaks the back of the trust question. A lot of the problem with metrics is when you show up at such a company and say, now, wouldn't you like to measure things better? And it usually is not exactly top of their list.
No.
And it often can chafe the relationship, which is getting chafed on many other grounds too, if you do this whole investing business right. So having somebody who can almost become part of their staff for a while, full of moral hazard. We don't like managing our companies. My former colleagues in IFC would hate this, but I say, look, unconventional problems call for unconventional solutions. If they knew I had a CFO floating around managing 4 or 5 companies' finances in India, they would be nervous about that too. But I say, if we're not making people nervous with these approaches, then we're doing something wrong. So environmental and social, and having a person who can go into Jaipur Rugs and say, let's do some random sampling of those 23,000 workers. How many of them exist? How many of them are, actually producing for you? How much did you pay them? And again, statistics being what they are, you don't need to sample very much. You just need to do it randomly, which is another issue. Walking into the manager's office and saying, let's see your stack of beneficiaries, which they probably don't really have. Let me pick 0.5% at random. That to me sounds like a smart way. There's almost none of our clients where this is going to be easy. So it's not, again, I probably give the image because of some of the other things we're going to talk about is I've given up, now I've got my money, I don't care about metrics anymore. It's really not that. It's that I feel like I've learned a lot about, let's say, the higher level building of superstructures before there's a lot underneath it. And that's what I'm a little worried, building these, what's underneath the scaffolding, let's say. Yep.
So let me ask one more question, and we'll go to the audience, which is, you think back 5 years ago, the discussion was all about standardization, and things like iris and gears didn't exist yet. So one could say that we've come a long way, and that we now have iris, we have gears, and we have a variety of other tools that are driving standardization and consistency. So could you comment upon the value of iris, and then your experience also with the value of gears, and any other tools that you feel like are pushing standardization? And are we where we need to be? Have we gone too far? Sort of give us your perspective on that.
Yeah, first of all, let me just say, iris and gears are spectacular, and I mean this, really good efforts that we've been part of developing the taxonomy and a lot of the efforts there, and I think good people with very good intentions are involved. I've also learned the hard way in my career that there's no one silver bullet or answer to most of these. There's a lot of different approaches needed. Whatever posture we're taking is specific to us. But that says something else, which is the move towards standardizing, building the superstructure before there's too much experience really exercising it. That's what I was saying earlier. That's what didn't happen in microfinance, and it was a good thing. I think there's a risk because this is just plain hard. I mean, if we're one of the major impact investors and we have a portfolio of $20 million so far, it says something about the field. And I'm not saying it's not as big as everyone says, but
it's not.
It's not. I'm glad you said it. But let's say there are big numbers being talked about because it's intentionally been built as a wide tent. I'm thinking now impact investing, but when I see $1 trillion or $2 trillion, and I realize what we have and Acumen has this, you add up all the major portfolios, there's a big disconnect. I think what's going on is, for a lot of reasons, it's been in a lot of people's interest to define impact investing as broadly as possible. The problem with that is what it means, what metrics is in different parts of that continuum are really different. If you're doing a do no harm type of investment as a major money center bank and placing your wealth management clients into pieces of paper that represent something developmental as opposed to locking your money up for 10 years in something like diaper rugs. There's a pretty different routine, I think, for metrics and many other things needed. And the idea that there would be anything like a standard anything in this field, I would say we have to be really careful. I think the taxonomy stuff, like what's a beneficiary and that sort of thing, is good. But if you think about it, so what does that do? It lets us all talk about how many beneficiaries we help. I don't know if any of you have had this experience, but we have, that we actually co-invest with other investors where we see very different numbers being counted and reported. So even that, and all of us are IRIS compliant, but the point is, how much did you have to do with the benefits you're talking about? What are those benefits really worth to the people you're trying to help? I don't think all the posting places and cross-cutting systems that were put in place over the last 5 years, to me, and I try to do this, I don't think they really give investors or us or anyone else really a real basis for comparing. So are the deals we do different, better than anyone else? So again, it's not that there aren't lots of strokes for different folks here, that just what we've come to as our solution, I'm not saying is the right way, or that a lot of the other field building efforts are wrong. It's just this idea of like everyone should do the same and let's build the structure before we have too much experience, I think is probably not the best way to proceed.
Well, I trust that might have engendered some questions from the audience. So let's go ahead and open it up for now, with me reserving the right to come back with some zingers a little bit later. So any questions? Wow. All right. Well, Amisha.
General question. We've been.
Say who you are and who you represent. So
I'm Amisha. I'm from Endeavour. We're probably slightly on the side of what you're talking about, impact investment as well. We work more with capacity building. But we've noticed a lot with our entrepreneurs that sometimes the path to exit is quite difficult. And I'm just wondering, you guys work probably earlier stage than us. What is your path to exit? Like, how do you envisage these entrepreneurs growing and maybe getting second or third rounds of capital?
Well, they do grow a lot. It's a good question. We intentionally designed our investment instruments and the fund to match that, to give us exits out of the company's cash flow. So even though they're equity type instruments usually, like subordinated loans with kickers or conversion options, it's a mezzanine fund. That's how we're funded, and to stay matched, that's the form in which we put our money in. So the exits are usually, at least as a fallback, and often as a first line, we have redemption or repayment by the company. Like I said, we almost always have a relatively low base rate. Right now, our cash on cash yield in our portfolio is about 7.5%, 8%. That's just the current income portion. And then we have kickers and upsides and all that. We do have warrants and conversion rights, so if some of these do well, that's going to be our upside, and frankly, that's going to be what allows us to pay a real return to our investors. I think principal back will be able to pay out of just what we're getting now. But remember, the 7.5 or 8%, don't be too impressed by, because that's just a gross return that we're getting now. From that, you have to subtract fees and potential for losses. So if we don't do better than that, our chances of paying something like mid-single digits are very low. And that's probably the minimum threshold that I would say would make us successful. So the problem with this is we're a mezzanine fund. We don't have a lot of Google-type winners that are going to pay for all the losers, but we are doing risky investments in countries where, even if we have security, which we don't always have, what we'd be able to get out of it is questionable. So in a way, if in a fund like this, if you lose 10 or 20% of your principal, you've got a pretty big problem with your returns. So it's not really an equity fund. It's not really equity capital for them. Someone earlier who mentioned this risk capital, it's a very big issue that we're not providing long-term equity for these companies, and it's most of what they need. We're often the first non-working capital outside funder that these companies have. So we spend a lot of time fixing up their accounts, their management, forensic accountants. That's the kind of stuff we do to get them fixed up. But I would say probably if we get real exits from third parties in a quarter of these, I would probably be happy. The rest will get our money back just from redemption and kickers built into the investment structures.
Yeah.
Just following what you just said, for the entrepreneurs, do you find that when you go and talk to them about investments, they actually understand what a kicker is, like how you're structuring it, or do you find that you actually have to teach them while you're investing?
Yeah, they almost never understand it when we show up, but I think they learn a lot working with us. This is one of the things. Just having to report and run their affairs in a compliant way and all of that is also a huge part of our capacity building. But no, the kickers and what a secured loan versus Most of them don't have that level of knowledge yet. And we're trying hard to stay out of the way of quote, real equity funds or others that do more sophisticated investments. As I always say, if there's a project that somebody else will invest in, let them do that. We're trying to build the projects into which we invest, so we're producing pipeline that others can do. And we're not really, I mean, I love to see our companies grow. I think our revenue growth on a same company basis is something like 20% a year. So it's not bad, but we're not in this frenzy of only if things do a hockey stick growth, will they succeed. A lot of times these companies are going to, if they're lucky, grow at 5%, or sometimes sales even go down. Structure them in a way that they can survive. Jaipur Rugs is a good example. Think about a company that does have exports. So what do? They fund themselves almost exclusively on short-term debt because that's the only kind they can get. And so what happens? That debt dries up right when there's a global financial crisis, which is almost always when the market turns down. And that's frankly what almost put them out of business last time. So part of what we're doing there is trying to not just put our own money in, but help them arrange a suitable long-term capital structure so that they're not exposed to that risk. I don't know if that's capacity building or just we get to do that. Yeah, we're also looking after our own interests, but I think the next step for us is, like we used to do in IFC, syndicated loans, where once we get something fixed up, we would put in, say, 20 million, and then others would put in 80, and we would arrange all that. I think a few of our companies are starting to get successful enough. This won't give us an exit because we're not going to leave that fast, but if we could now raise that other 80% of the long-term capital from others, it would have to be probably big agencies in that case because they need long maturities. This is a long-winded answer to this question about exits, that we don't want to get out by some other institution buying us out. We'd like to get out by the companies being successful and either a trade sale, I don't think there'll be listings of any of these, or just paying us back out of cash flow if they have to.
Maybe a flying carpet, flying Jaipur rug. Jed, you had a question?
So you talked about, I'm Jed Emerson, various hats here with Blue Haven Initiative. You talked about the kind of the going deep at the company level and trying to build just some very fundamental kind of metrics. You talked about the infrastructure play and Iris and Gears and all this, but it seems like there's a missing middle in terms of connecting these individual groups into clusters, whether it's done in terms of capital stage or market segment, that could really help kind of move and leverage it up and in, you know, where. And so I wonder if you could reflect on, are you seeing anything in these various regions of people bringing together kind of like companies, or, and again, either in terms of business model or in terms of capital development, where you could have conversations about how to aggregate more of these individual companies into kind of clumps where we could actually begin to look at them as like and can. Do you know what I mean?
It's an excellent point, Jed, and quick answer is, yeah, there's a ton of potential for that. We're just starting, now that we've got 7 or 8 investments in each of our regions, to see a little bit of that critical mass, and one of them saying, gee, I'd like to learn from what Jaipur Rugs is doing because I could use that. So we're starting with a website and a couple of get-togethers to see if we can build just within our own client base. That's nothing like what you're talking about. If we did this, share good business advisory service models or ways to deal with environmental and social issues. They do have a bunch of common needs, and they're all hungry for that, but they're all terribly bandwidth constrained too. So there's something to be done there. We're kind of thinking that if we can build a community among our clients, which will soon be 25 or 30, and start having some commonalities and shared principle, I think then we would love to sort of open that up to the investees of others. And I think that might be something Andy could help with, that the convening of a bunch of SGBs that have similar problems, just pulling off quarterly board meetings and having a reasonable governance regime in one of these enterprises, unfortunately, is a big breakthrough. And it's so common what we're doing across, must be 10 or 12 of our 20 investments just on that. I think there's a ton you could do locally. The problem is we tried also putting on seminars for a day or two. These guys are busy and they're stretched, so they don't want to sit in a classroom setting. What they need is information, a little bit of a common something, but then someone who can go out and help them apply it. This is also something I would suggest for things like Gears also, that Gears is a great thing, but these companies need a lot of help to just interpret the questionnaires and then do something about it. As I've said to Jay for a long time, why don't you guys get some of that resource and make it available to people to help the companies fix up what's wrong? And that would be a very good thing. You could do a lot if just in the East Africa hub, you could probably get 50 or 100 companies that all need the same thing. So if anyone's interested, we're totally open book on this sort of stuff. We'll show you what we're trying to do just among our, this website we're building, and I think that would have a potential. Problem is, I'm rambling, but you'd also have people to be pretty open. When we grade our technical assistants pretty hard, and so we're also wrestling with that. So we give like ability scores for governance, financial planning, environmental, and social. That's there. So how many companies that we invest in are going to be willing to have their dashboard up there, which we review regularly, but gives them failing grades on 3 out of the 7 things. We may have to, let's say, sanitize that a little bit. But I don't think that's hard. We also have these models for rotating CFOs and things and people we've used for it that I think would be helpful for Calvert and Acumen and Root as well. Yeah?
Kelly, do you have a question?
Yeah, so kind of following on your recommendation about using Kelly McCarthy with the Gen. Following on your recommendation for gears, kind of using that assessment with entrepreneurs, I was wondering if you could offer any additional thoughts. You mentioned, the superstructure is there, but we're really light on content right now, or really light on the actual structure. I'm curious to hear if you have any recommendations for what we could do to sort of catch up in that area. If it's a capacity issue, if it's something about helping to equip sort of the next generation of impact professionals with the skills, or I'm just curious to hear what your thoughts are.
You're talking specifically for gears?
No. Just in general, you were talking about sort of the superstructure, tools, resources, iris gears, and other things have been built, but it sounds as though the concern is that what's following the content isn't exactly there.
Yeah. All right, so let's take one example. That's a good question. So take, like environmental and social, something out of the gear survey. Let's say, what kind of environmental or labor practices does the company follow? That's a big issue, and very few of the companies we work with would really totally pass with flying colors, but they could all benefit. So a little bit like what Jed was saying, if there was a gears resource, or it doesn't have to be gears, it could be part of ANDE or something else to say, I don't want to say provide a goodie, and I'm not saying for us, but our clients would be a lot more inclined to work on these things if we said, look, if you are revealed to have bad labor practices, we have an expert on that based in Nairobi, or that guy will come and work for 2 weeks with you and come back for 2 days a little bit later. That's what a lot of these companies need. That's ungodly expensive and complicated to organize if you do it on a spot basis, which kind of we're still doing. Now we're starting to get some economies because at least we have a few clients in the same area. The dream would be moving towards, like what Jed was saying, in East Africa you probably got 50 or 100. You could probably keep a full-time person busy on each of these. If we think of what we do ability scores for, it's what I said, governance, financial planning, financial management, environmental, and social. We're out of desperation thinking of bringing in our own person for each of those just so that we can rotate them around to our portfolio. But how much better would it be if you had good local providers that you could invest in? You could do vouchers or get the World Bank, or these guys that spend $50 million a country on, I hope there's no one from the World Bank here, but
I'm sure there is.
But the pattern in the development business, all the big donors do $50 million, $30 million business development service programs, and as a former Secretary of Treasury said on one field trip, hard to see where all that went. And what do you do with, once you have classroom training of business development service providers, what do you do with them? My argument is, just like I said about the scaffolding here, it's great to train these BDS providers, but it's only great if you get them some practical work to do. So if you could go into that classroom with people that just got $20 million spent on their training and say, let's pick the best 3 and go into a bunch of GBF or Acumen projects or someone and go untangle their books. And that's unfortunately, even in Africa, when you get a big 4 name on your accounts, doesn't mean that much. And a lot of times we have to hire good local. So anyway, the point is develop good local BDS providers. This story that the international consultants give you, which I always used to hear, that there's no good local providers, you have to use us. And of course there are local providers, and a lot of them have been expensively trained. It's just there's never work for them. So we've got 3 or 4 in East Africa that we use, and we can almost keep them busy full time. But I'm saying develop the BDS providers and mechanisms, and then people who come in with that BDS money, as I always say to my former colleagues, give out vouchers. You can control who the vouchers are used for, but you say, here's a $80,000 voucher, and you can use it for an agreed list of providers to help you pull off a reasonable governance structure. That would be big.
The young lady whose hand up is in the back. That's you.
Okay, I was thinking young lady. Thanks. I usually get the madam. So I'm Jessica. I'm with Vilgrow Innovations Network. It's an incubator in Chennai, India. And just wanted to two comments. One is we'd be really happy to work with you on some of this peer learning about common challenges and impact reporting and impact management. We're starting to do that with some of our incubatees now, and we're seeing a lot of interest just in the small portfolio for people learning from each other. And so joining forces, and we're also seeing some common problems coming out. So that's the quick answer, but a quick comment. The question I had was actually about these conversations that you're having with companies now to try to simplify the indicators and develop a set of indicators that make sense and that the companies want to know for operational reasons, as well as that are helpful for understanding the social impact. Do you find that, or at least the social outputs, do you find that there's generally agreement between your portfolio managers and the people in the companies about what are these two or three? And if so, that's great. If not, how do you deal with the disagreements?
Often there is not such agreement that a lot of times.
That's what we have to.
Remember, at the time, we're trying to convince them to do proper impact tracking and environmental and social behavior. We're also trying to convince them of about a half a dozen other things, like run yourself like a real company and have a board, which most of them don't yet. Let us help you develop a proper financial plan that'll gird you for world cycles. So all of these are also invasive. These are almost always founder and family operated businesses. And even though I wouldn't call them social enterprises with a capital S, they're real for-profit businesses, but they have big social impact business models. They take some convincing. Take Jaipur Rugs as an example. You can feel they have a very good business model when you visit them, and I believe that's genuinely easy to show that they're helping a lot of very poor people make a good living. But if the issue is how to do a systematic study like we're doing now in India, where they're one of the ones we're studying and doing the spot sampling, that he needed to see some business benefit. So the way we did that was, you go into any of the US outlets where you use this Jaipur Rug sells their rugs, and you see a big stack, ugly stack of carpets, and not a word about all the social good. So in that case, we said, look, Yogesh, the head of the company, wouldn't you like they have a little foundation that does mostly training of weavers in villages. Wouldn't it be a good thing if using that distributed mechanism, we could help you get an idea of who you're helping, and then help you tell that story as part of your marketing. So they see the social metrics as something they can use in their own marketing. That made a big difference in that case. Now, we don't have that particular dynamic in a lot of ours, but I call it crawling under the tent. Almost never can you walk in on metrics or governance, or a lot of the most important capacity building areas are invasive and I want to say almost offensive. I mean, I feel it in a way because I have a governance arrangement too, and I feel just like our clients do. Who's my board to tell me what I know what I'm doing? They feel that way too. And it takes a year or two to at least to get their trust. And Jaipur Rugs was unusual because that one needed a big chunk of work before we put our money in. Usually we do very little before, except making sure the accounts are the way they are and all that. But we put in money for a year or two afterwards, and we often shape the technical assistance program around exactly those sorts of things.
Let me just make one comment on the first part of your comment. As I suspect there's a very active metrics and research working group within ANDE, and it exists in large part to try to help these kinds of discussions where people are trying to collaborate. So for those of you who are members, if you happen not to be participating, although I suspect most of you are, if you're at this conference, please take a look at that. It's one of our most active groups, and Genevieve or Sarah can say more.
Actually, just one follow-up. Thanks for that. One of the things that we're finding at Vilgrow similarly is that one of the most effective ways to communicate the need for collecting this kind of information is pointing to for-profit or larger companies that don't have any sort of self-identification as having social impact, and saying those guys collect detailed information on the value they create for their clients. That's part of their business strategy, is basically trying to convince through sort of cases and information on non-social businesses well outside of the kind of development literature on the commercial importance of information. So for those of you who are in research or looking at kind of the support for doing this, the more documentation we have on the information and client and employee information management practices of businesses that small and growing businesses see as their potential, I don't know, peers, mentors, et cetera, that's very, very helpful. And it's a little at odds with, I think, the first instinct of many of us to go for development research and for development benefits, but it's incredibly helpful.
So if I could say also, where Vilgro operates in the Indian continuum of business is exactly where the biggest gap is. I have huge respect for that. And hearing the talk here about incubators too, that gap between inception and what I would say growth stage, where people like us can put $1 million or $2 million in, that's a very under-attended to gap. And if anyone could figure out what to do about that, it's still, I mean, I know Paul pretty well and I've visited before. I love what you're doing. It's just it's like business plan competitions. You know, a lot of times the lights go off, you know, the interest wanes quickly after the award ceremony and people get their check or recognition. And when I was at the World Bank, we used to fund them all the time and I used to go crazy. What do you think happens after the lights go out? The guy gets his check and then what do I do next? There's a gap in there, which is not even so much capital, but it's mentoring. What happens here after your first round or your inception is there's an ecosystem that gets you all that kind of help. In India, I think that's still hard. If we'd love to work on that maybe in our next round. I'm thinking of some kind of facility, if we could sell our donors on this, to try to be able to operate more in that space. Because right now when you've got I hate to put it this way, a gun pointed to your head on servicing your capital, it's kind of hard to take those risks of something that's just out of an inception stage, say incubator.
Let's do.
Actually, I mean, I've been in Chennai for about 6 years now, but I just started working more closely with Vilgro to start to fill in, to make more sense of the muddling around that we're doing in this space, because it's a very, you know, these are companies that, you know, are still getting set up as companies. But we feel that intervening on the metrics part, even at this early part, even this very, very early stage is important, but we're still muddling. So over the next few days, hopefully,
we're going to figure it all out.
Yeah, all of it and then go back.
One last quick question here in the front row, since you're second front row.
Great. Hi, I'm Sarah Grant from BDS Africa, a venture incubated by EWB. And
that's Engineers Without Borders, for those of you who don't know the acronym.
Canada, just to make the distinction. First off, as an engineer, I appreciate that you bring a very pragmatic approach to measurement, and having worked on the ground and supported a team that's working on the ground, I think it's easy to get caught up in what you want to measure and forget about the realities of what's possible and the feasibility there. So I liked that part of your talk. I feel like the next obvious question where you ended things I just want to ask is, you mentioned that you're worried that things are getting standardized too quickly now. So my question to you, which I know is not probably an easy one to answer, is how will we know we're at a point where we can standardize things?
I would say look at what you've got. When you have any kind of posting system where all of this is supposed to come out to something where you can compare different players, I would say keep doing that. So, I mean, I'm not criticizing any of the things that have been built so far, but is anyone able to get practical value? And I would say less about the fundraising. People always say with our Gears decision and all that, it's all because of fundraising. It's not. A lot of it is just operational practicality. So could somebody go and learn something useful about agriculture in Africa by looking at the different posting sites that are supposed to let you do this? If you keep asking that question, so can I, or the people that we're trying to benefit from the way this superstructure is built, I think that's what answered a lot of the question for me. Because again, we're taxing these relationships with these investees of ours so much that it's kind of a self-regulation for us. The clients will say, sorry, this is too much trouble. I'll keep funding myself on expensive short-term debt, or just not grow rather than go through, and that's happened a few times. The difficulty is in imposing, let's say, a disciplined approach on that sort of thing. Is there's so much interest in these few geographies where everybody is, that if you try to stick to your guns on things like that, there's usually somebody else that'll come in and do it without that. So that's, it's complicated to impose, let's say, yes, this is how we're doing, and you're going to have to sort of comply with this, because there's all kinds of money in Africa for this sort of thing, and some of it's hard to get at, but some of it will just plop out into some of these companies, and sometimes, a lot of times, capital is not their biggest constraint. It's being disciplined about getting better. And, you know, actually, this self-criticism and this openness about what's working and not, that's another big thing that I feel like we have a bit of luxury because we have a few years of money and we don't have to be fundraising all the time. One of the problems I think in the metrics field is because there's so much fundraising and everyone's in fundraising mode most of the time, it's really hard to be open and self-critical about what's not working when you're always afraid there might be one of your next donors in the audience somewhere. So that's a big problem because there's, as I always say, for those of you who follow American baseball, what's a good batting average? 250 is good. 300 gets you the batting crown for the, so, you know, as somebody used to say at the World Bank, anyone who says they're batting 500 or 750 is either playing slow pitch softball or they're misrepresenting or lying. So yeah, I don't know if we're doing as bad as 250 or 25%, but I'd say not more than half the things we do works. And if we're willing to call out the mistakes and learn from them, I think that's a big contribution to the field. That might be another thing that if there's Andy can capture that moment of people who have a brief respite in the fundraising routine to say, yeah, I've screwed up quite a bit, and here's what I've learned from it. To me, that's pretty useful.
Well, for the record, I do bat 500 in my slow pitch softball league, and I'm hoping that we're batting more here at ANDE. Thank you, Harold. I hope you'll join me in thanking him for a really wide-reaching and deep conversation. We really appreciate it. Thanks for your support 5 years ago and today. Genevieve, what's next?
A break. You can all stretch your legs, grab some